Today we're going to talk about trading call verticals and how we modify those into barbells. And then how do we use barbells to take advantage of unlimited gains when the market's shooting up. You'll read about call vertical spreads in your academic books. You will not read about barbells. You only hear about them here. So let's get started and let's talk about how we do a trade with a call vertical and then move forward into the barbell. We're going to hop over to ThinkorSwim. The chart we're going to look at today is Bed Bath & Beyond. As you can see here, the stock opened up around 22, shot up to a high of almost 27. We're going to use the Analyze tab to do this. So let's start with a very simple approach in using this risk profile page to learn about how the barbell outperforms call vertical spread. This is your profit on the left side, on the y-axis. Above zero, this is how much money you're making. Below zero, that's how much money you're losing. This risk profile is going to show us what happens to our position over time. So this is a great way to think about the risk and returns of your option strategies. Down below is the price of the stock. So Bed Bath & Beyond was 22 this morning. If it hits 36 this week, as it goes up, calls will be worth more. You expect to see the charts and profits go up as the stock goes higher because we're doing bullish call spreads. So let's jump in and let's put that call vertical spread on. First thing we want to do is buy an in-the-money call. We're going to buy the 24 call on Bed Bath & Beyond. Other call we're going to want to do is an out-of-the-money call that we're going to sell that one. So you're going to basically hit the bid on that one. If you do this as a vertical spread, you can enter one trade. I put this trade on earlier today. The calls were actually below 3, the 24 calls, and 30 calls were actually below $1. So I'm just going to put these prices in to reflect where they were this morning. So let's go back to the risk profile page. We have some lines. Down here, this tells you what your P&L is, and there's the date. So there's two lines. There's the purple line is today. The blue line is on expiry. They're going to expire on April 9th, so we got a week and a half. As you can see, if the stock shoots up to 35, this blue line above 30, which is on expiry day, any price above 30, a $400 profit on this one call vertical spread. That's why that line is flat. It shows your profit over here of 400. So even if we go to $100, you'll never get more than 400. We cannot lose more than 200 even if the stock goes to zero. So that's the advantage of call options. They limit your risk, and the disadvantage of a call vertical is you cap your gains. But hey, you brought your cost basis down to only 200. What we learned with GameStop last year is that if you had limited profit call spreads on, you could make 10 times, but you couldn't make 100 times or 1,000 times. So one of the modifications I've made to this, and why it's called a barbell, is because we have this in-the-money call, the 24 at 3, is I'm not selling the out-of-the-money call, I'm buying it. So now we're buying an in-the-money call and we're buying an out-of-the-money call. Before, we only had a risk of 200, but look at this. Now, at expiry, our risk is 400. So our risk has gone up, not down. But look what happens at 30. Instead of limiting our gains, now if we get to 35, now you're looking at making $1,200 instead of $400. So now we have unlimited gains. And if it goes to 40, you can see down the bottom left-hand corner there, then it's $2,200. So right here, they tell you that at 40, it's $2,200 on the blue line, which is the day of expiry. So in this example, our risk is higher. We have unlimited gains. Now, this is what I'm doing with my barbells. When the in-the-money of the barbells goes above the cost of the out-of-the-money call, I'm taking off the in-the-money call. Example from today, the 24 calls went from 3 to over 4. Now, I knew I'd only paid $1 for the 30 calls. So when this got up to 4, I sold this to basically pay for the other call. Does that make sense? I made $100. Now our risk is only $100, but we only have one call on instead of 2, but we have unlimited gains. Now, this is not entirely correct. The part of the barbell strategy was to sell the in-the-money call to pay for the out-of-the-money call. So by right, what I should be doing is changing the value of this call from $100 to 0 because I paid for it already with the other in-the-money call. Now look at my profile. I cannot lose money on this barbell anymore. My risk is 0, but look at my gains. Unlimited gains to the upside. Can you imagine last year if we were doing barbells instead of call vertical spreads in GameStop? instead of making 10 times, could have made 100 times, 1,000 times. So we'll see what happens with the meme stocks this week and next. But if we have another big move like we had in January of last year, those barbells are going to print like nobody's business. So anyway, that's just a different kind of strategy. Obviously, options can be used in a lot of different ways. That just gives you an example. There's the call vertical spread, lower cost, limited gains, and then there's the modified version called the barbell. Barbell is we're buying the in the money, the out of the money. We're taking off the in the money to basically fund the out of the money call, and we let that guy run 10 times, 100 times, 1,000 times, right up into expiry. You set your own goals in terms of what you're trying to achieve with these different stocks. So give it some thought, leave some comments down below. Happy hunting.